Hello, my name is Charles Kreis, and today I will present a carry trade opportunity in the foreign exchange market. Return dispersion serves as a proxy for how accurately assets are priced in the financial markets. A historical analysis of dispersion superimposed with hedge fund performance reveals that in periods of high dispersion, equity hedge funds outperform relative to the S&P 500 index, whereas in periods of low dispersion, the funds underperform. As shown by the figure, U.S. equity markets are in a period of low dispersion, signifying the difficulty of identifying profitable investments in the current equity markets. Looking at U.S. equity valuations relative to the GDP show that valuations are approaching record high levels. By historic standards, U.S. equity investments appear unattractive. Given recent geopolitical events, volatile commodity prices, and unprecedented national bank policymaking, I propose that asset mispricings and investment opportunities lie within the foreign exchange currency markets. By borrowing in a country with low interest rates and investing in a different country's government bonds, significant profits may be realized. I believe that the Swiss franc will stabilize or depreciate against the US dollar. With negative interest rates, it is an ideal currency to borrow for this investment. I believe that the United States dollar will appreciate against the Swiss franc, and with leverage, the interest rate differential may produce sizable returns if U.S. bonds are purchased. I will now present my rationale of why the U.S. dollar will appreciate. The United States economy is growing. High forecasted GDP growth is warranted by steady corporate profits and high consumer confidence. Recent improvements in employment paint a similar picture. These economic developments and a hawkish Federal Reserve suggest that it is likely U.S. interest rates will increase within the next year. Given the opposite policy of other major national banks, the U.S. dollar will appreciate as investors pool their money in U.S. government bonds. The U.S. dollar is already on a tear, but at 7 months the bull market is still young. The trend could last for years given the divergence in monetary policy and economic conditions. Now I will present my rationale of why the Swiss franc will stabilize or depreciate. In 2011, the Swiss National Bank pegged the Swiss franc to the euro. However, the bank could not sustain the asset purchases required to maintain the peg with the depreciating euro. On January 15th, the Swiss National Bank made the headlines when it announced a depegging from the euro. The Swiss franc initially jumped 30% against the euro following the announcement. Nick Hayek, the chief executive of the Swatch Group, called the action a tsunami for the export industry and tourism in Switzerland. Swiss equities fell by 9%. The series of events suggests that although the euro peg cannot be maintained, the Swiss National Bank must prevent significant appreciation to the Swiss franc to protect the Swiss economy. Even prior to the September 2011 peg to the euro, the Swiss franc has always maintained a strong correlation with the euro. Because of the strong correlation, it is safe to assume that if the euro depreciates, it will result in the depreciation of the Swiss franc. Many factors contribute to the ongoing depreciation of the euro. Risks of a Greek default always loom over the Eurozone, with fears of a Grexit amplifying following Syriza's victory in the Greek election. Russian military intervention in Ukraine and the following economic sanctions have continued to hurt Europe's economy, a large trading partner of Russia. Economic indicators in the Eurozone suggest a slowing economy, and the European Central Bank has been forced to respond with over 1 trillion euros of asset purchases to stimulate the economic activity. The events will create a decrease in European interest rates and massive euro shorts driving the currency's depreciation. The boxed regions in this graph depict decreases in the value of the euro. As shown by the figure, the euro stands at its 20-year moving average, suggesting room for depreciation. If the euro loses value, the Swiss franc will follow and the position will outperform. As a currency pair, the presented evidence reveals that the exchange rate will move in favor of the trade, while the position provides a positive carry. Even through economic crises, bull markets, and bear markets, the currency pair exhibits low volatility, suggesting that the profits from the carry position may be realized for a long duration. To conclude, fundamental and technical factors suggest a profitable carry trade investment in which U.S. bonds are bought with borrowed Swiss dollars. Thanks.